Welcome back. This is India Market Open. We're taking stock of the futures and options space. It was an interesting half an hour of trade yesterday. There was all sorts of jokes that, hedge funds are back in action when it comes to the final day of the expiry, specifically the final hour expiry, because of the kind of sharp movements that we saw on the benchmarks in the last hour of trade. That said, we did see a significant recovery, and to a certain extent, a lot of that trading action was on account of the weekly options expiry when it comes to the Bank Nifty. But I'm going to start off with the basics, start off with the futures space and how things are panning out. Now, the Nifty eventually, at the end of the day, did close with a gain of 1.3%, moving back about the mark of 22,500, which remains a little bit of an important mark because that's where we've seen the Nifty consolidate over the last few weeks and move in and out of this specific level. We did see a little bit of unwinding as far as futures are concerned, and that was the case when it comes to the Bank Nifty too. The Bank Nifty had an interesting move yesterday, but specifically in the last half an hour, as I was mentioning, yet we saw about 0.5% cut there, and overall we saw unwinding to the tune of nearly 6% in your respective futures as well. Today is the weekly options expiry for the Nifty. This one has also been in focus because we've seen extremely choppy weekly options expiries for the Nifty over the past few weeks, even as the volatility index rises, and that's largely on account of expanded option premiums. But what we are seeing yesterday is a lot more writing in traction as far as puts go, as you can see on your screen there, denoted by the red bars. But what about your overall open interest when it comes to this specific expiry today? Well, we're watching out for the 23,000 call on the higher end, and on the lower end it's fairly spread out between, and that by that I mean puts. Puts open interest has been fairly spread out between 22,200, 300, 400 and 500 strikes. Now, that also means that traders at the moment on the lower end are a little bit more uncertain, and I wouldn't blame them because we have seen that expansion as far as premiums go. Of course, on the higher end, there's a little bit of cementation when it comes to the 23,000 call. Let's move on and talk about the other factors. Of course, we're also talking about the June 6th expiry. We are tracking that on a day-to-day basis. What has really changed, and perhaps the only thing that has changed, is that when it comes to the 22,500 strike on the 6th of June expiry, the puts have seen a little bit of an increase in terms of open interest. On the higher end, 23,000 call, once again, continues to see increased traction, and I'd reckon that while we see it from a writer's point of view, I'm sure there will be many traders in the markets who will in fact be looking to potentially go ahead and buy the 23,000 call as well. It's a wait and watch on that one, and again we've already seen some elevated levels when it comes to premiums there, even as the Nifty moves higher towards the mark of 22,600. Now let's talk about stocks, and again, that's where largely on account of earnings reaction. But longs for Page Industries, Lupin, Birlasoft, shorts for Apollo Hospitals and Jubilant FoodWorks. In terms of other stocks which are in focus, in terms of unwinding, we saw short covering for Granules, PI Industries and Dr. Lal Path Labs. Sale in IEX, see a little bit of longs unwinding. But what are we doing with these markets? How do we, what's the way forward? How do we deploy option structures? That's where we are shifting our focus to in this particular segment, and we'll get an expert in. We have Rahul Ghosh of Hedge.in who's joining us on the show right now. Rahul, good morning. Thanks for joining in. We spoke to you last week and you had a very interesting strategy for us, a very interesting option structure for us. But this time around, you are actually working with slightly different expiries. Firstly, what is your view on the benchmarks? And perhaps then we can take up the option structure you're deploying here.
Good morning, and thank you so much for having me once again. So yes, you were absolutely right. The structure we created last week, which was a 4-leg structure, is currently playing out very well. It's currently in the green. So for all the viewers who had taken it, they should continue to hold on. Our view on Nifty continues to be on the bullish side. Even just a couple of minutes back, as you mentioned, the 22,500 P for the 6th June expiry, the put writers are very, very active over there. So our bias continues to be on the long side. It might not be a runaway rally before the 4th of June. It might be a slow rally. And keeping exactly this point of view in mind, we've come up with a strategy. What we're doing is we're buying the 27th of June monthly expiry 22,700 call, which is trading around 580 odd rupees. And simultaneously, we're looking to sell the 23,000 call of the second week of June expiry, which is namely the 13th of June expiry. Now, the reason we're doing this is taking into account maybe a slowish movement on the upside and not a runaway rally. Having said that, even if there is a runaway rally, the strategy still benefits greatly. Number two, this strategy should be entered when Nifty is closer to 22,500. I think currently Nifty is opening around 2540. So that is good enough. So as close to 22,500 as possible, you would want to deploy this. The reason two different expiry legs is because the 13th June expiry leg will erode faster, and the end June expiry leg will erode slower. So that would give us some time to make some modifications where we can sell the third week of June, fourth week of June, so on and so forth expiries to bring down the initial debit in the bot call. That is to bring down the initial debit in the 22,700 call. The risk in the trade is about 4,000 rupees and the capital required should be around 20,000 rupees. So capital required is quite low. Even people with smaller capitals can participate.
Right. Rahul, I reckon that the implied volatility on the expiry, which is closer to us, will be relatively higher. I reckon that to a certain extent, we are taking advantage of that as well when we go ahead and, in fact, sell the closer expiry and buy the further out expiry.
You're absolutely right on that. Ideally, we should have done it with the 6th June expiry, since you mentioned this point. But the only trouble with the 6th June expiry, if I sell the 23,000 call, was in case there's a very sharp movement, one might get stuck on the upside, which is something we didn't want to fathom, or this is something we didn't want to take a risk in. That's why we went ahead and sold the 13th June expiry, which was giving us a little more premium than the 6th June expiry.
So that's as far as your option structure is concerned when it comes to the Nifty. And this time around, Rahul has given us another option structure to deploy, which in fact does not involve the 6th June expiry, but the subsequent expiries thereon. That said, Rahul, I believe you also have Bharat Electronics on your radar this morning.
That is correct. So Bharat Electronics has seen a stellar move for quite a while now, and yesterday also had a nice big bullish candle or an engulfing candle formed. So we're looking for a safe option structure which involves futures as well for a bullish move in the month of June, because May hardly has any time left. Now, if you do the maths on this structure, if you put it in one of these trading platforms to do a payoff graph, you will find that the risk is very, very low, even though we are using futures as an instrument. What we're doing is once BEL crosses 285, we would buy the June futures, buy the 285 put. I repeat, once prices cross 285, we would buy the June futures, we would buy the 285 put of June end expiry, and simultaneously sell the 290 call of June end expiry. So three-legged, completely protected trade. The trade makes money if BEL stays sideways or moves up in the month of June. The trade loses a very, very low amount of money when prices go down and does not go in our favor. One small modification I would suggest to viewers in case prices go below 275. Modification that they can do is roll down the 290 call that they're selling to maybe 287.5 once prices go below 275 and after 6th June. Mind you, please note this is after 6th of June.
Of course, the advantage of the rollover would also be to curtail your outgo to a certain extent. But with that, Rahul, I'm going to take a moment to thank you for joining us and helping us out, deciphering this market also, what we can do by reusing options. We'll, of course, continue to track those strategies going ahead. With that, it's back to you, Samina.